I welcome you all to this very important virtual outreach on the IFRS 18. Friends, IFRS 18 basically, if I talk about, is the presentation and disclosure in the financial statements, which was very recently issued in April 2024 and is effective from 1st of January 2027. And of course, it would be replacing the current IAS 1. So in India, we are having Ind AS 1. So we'll be working upon and going to the Ind AS 18. If we talk about what is it basically about, basically it would be about the presentation and disclosure in the financial statements, which would be in the income and expenditure account. It would be classification of income expenses into operating, investing, and financing categories, and certain additional items. And for that, in India, we are having this outreach program where we are having from the International Accounting Standard Board, Hagit Karen, Rona Hasegawa, and Deborah Bailey for the International Accounting Standard Boards. The member is, of course, Hagit, along with her technical team. And of course, later on, we are having a panel discussion where we are having our own past president Manoj Fadnis ji, MPV sir, MP Vijay sir. आदत पड़ी है sir MPV sir बोलने की तो वही रहती है. And of course, C. Amrita Shrikant ji. And to moderate them, we have got Archana Putani. But to start the initial wisdom, we have our president of ICI, who hails from Kolkata. So I'll request our Honorable President Ranjit Kumar Agarwal ji to share his words on this outreach program.
Thank you very much, Honorable Vice President of our Institute, CS Nandaji, the Chair Fadnis, the member of the International Accounting Standard Board, Miss Kiran is there, technical staff of ISB also there, Parvinder Kaur and SN Gupta, the technical team from Institute of Chartered Accountants India. Thank you very much for initiating this very important discussion on this IFRS 18. The kind of complexity of the business and the kind of pressure on the disclosure requirement across the world is there, because the businesses are going to be very, very complex. At the same time, to disclose this entire complexity in a very lucid manner is a challenging task. And that's why the Internal Auditing Standard Board, the IASB, has come out with this IFRS 18. And this in India, we also have to align, as in the past also the Institute of Chartered Accountants India has converged IFRS standards with the Ind AS way back in last so many years. And as per the Indian economy, the things are also changing very fast. So as far as this measurement of this financial performance is concerned, that will still is there. How to present and disclose this financial performance, that is the challenging task now entire world is facing. And that's why this board has directly come out with the IFRS 18 and how they can effectively communicate in their financial statement with a focus on the instrument of profit and loss account. And I was also going through these highlights of this IFRS 18, which talks about how to classify income and expenditure into operating, investing, and financial categories, and how to show the operating profit or loss before financial and income taxes. All these new parameters they have introduced. We are in the right path to debate and discuss this IFRS 18 and how we can converge as far as Indian accounting standards are concerned, and how we can disclose effectively the various information which is the requirement of the stakeholder. Recently, the SEBI has also expected that the issue should come out with a new reporting format as far as this digital audit is concerned. And the institute has given a statement how the digital reporting will look like. So all the regulators, stakeholders need some information, and the institute is there to provide the solution in this regard. And I must compliment this board who are spearheading this new initiative to discuss this IFRS 18, and hopefully with the various discussion, debate, and deliberation by this webinar with the stakeholder, something new inputs will come, and then the institute will deliberate in the council also as far as this IFRS 18 and the converge IFRS 18 as per the Indian requirement is concerned. So my compliment, Pramod Bhai, you, Parvez Hajar, the entire team of the ASB for discussing this new initiative, which is going to be implemented from January 2027. So you are thinking ahead and you are discussing the things which are coming after 3 years today itself. So my compliment to all of you. Thank you very much. Thank you.
Thank you very much, President Sir, for your very enlightening opening remarks. Thank you very much, sir. Now we have our very honorable Vice President, C. Charanjot Singh Ji Nanda Ji, who is from Delhi, India. I'll request our honorable Vice President to share his words of wisdom for the public at large.
The Honorable President of the Institute, C. Ranjit Agarwal, the very well-deserving technical chairman of the board, C. Pramod Jain, Vice Chairman, C. Abhay Chajarji, my very senior colleague, past President, Shri Manoj Fadnis Ji, again my past council colleague, MP Vijay Kumar Ji, Ms. Haggett, C.A. Amrita Srikant, Ms. Rone, Ms. Deborah, Madam Archana Bhutani, and all members. Today marks a significant milestone in the realm of accounting standards as we delve into the realm of financial reporting. The International Accounting Standard Board has revealed its latest masterpiece, IFRS 18, which is on presentation and disclosures in financial statements, poised to replace the stalwart AS1, which is presentation of financial statements. This unveiling isn't just about a new set of rules. It is about revolutionizing how entities communicate their financial story, one of the very important facets. This unveiling comes because of the Primary Financial Statements Project, a visionary initiative aimed at revolutionizing how entities present their financial information, effective from annual periods commencing on or after January 1, 2027, which is what the Honorable President also hinted. IFRS 18 is not just a mere regulation, it's a beacon of transparency and clarity in financial reporting. Now let's ponder for a moment on the significance of financial statements. These general purpose financial statements are the lifeblood of decision making for stakeholders, whether assessing financial performance, solvency, earning capacity, or growth prospects. Users rely on these statements to navigate the complex terrain of investments and decisions. Hence, it's not a duty, but an imperative that these statements paint a true and faithful picture of an entity's state of affairs. In this journey towards transparency, qualitative financial reporting becomes our guiding light. Compliance with accounting standards and regulatory requirements lays down the foundation of robust financial reporting practices. It's these principles of regulation that ultimately elevate the quality of financial decisions. Going ahead, I would like to just conclude by saying that in India, this journey towards convergence with IFRS will see the formulation of Ind AS 118 by the Institute of Chartered Accountants of India. We all can agree that any change encourages continuous learning and professional development. At the same time, transitioning to IFRS 18 will also bring changes in existing accounting policies, systems, internal controls, which can be only addressed by awareness, planned roadmap for implementation, training, etc. In conclusion, as we embark on this journey towards transparency and clarity in financial reporting, let's embrace change with open arms. Let's harness the power of IFRS 18 to not just meet regulatory obligations, but to elevate the standards of financial reporting to new heights. I wish Accounting Standard Board all success in its initiative to create awareness and, more importantly, enhance the financial reporting standards. Thank you. Thank you so much.
Thank you. Thank you very much, Vice President, sir, for your enlightening remarks. Thank you very much. Friends, now we are having this session today. First, an education session where the ISB members, they would be sharing their initial views or what is about by this IFRS 18, and then we would be having a panel discussion thereafter. Ms. Hackett would be joining in the panel discussion. But let us start that education session first, and for that we have got Ms. Hackett Karen, who is an IASB board member. Friends, International Accounting Standard Board, like in India, we have Accounting Standard Board. IFRS Foundation is having an International Accounting Standard Board, wherein this all in IFRSs are basically discussed and then issued, of course, formed and then issued. So she's a board member and she has joined this ISB in the month of March 2023. She has got nearly more than 20 years of experience in auditing financial statements, prepared using the IFRS accounting standards and helping companies to implement and apply the standards. Along with her, we are having the IASB technical staff, Ms. Roni Hasegawa. She joined the IASB in 2021, and she is leading the project of the primary financial statements. This is the project. And along with her, we have Ms. Deborah Bailey. She has joined the ISB as a technical staff in December 2021. She is also a member of the primary financial statements project team, and most recently, she has served as the technical manager for the listed preparers. Welcome all ISB, the ISB members and the technical staff. And over to you to share your views for the outreach program on this IFRS 18.
Thank you very much. So you can see the slides, but I'll open up with say hello to everyone. It's very good to see you all. We are very honored to be in such a respectable company of professionals, and I can say I am moved by the introduction provided by you with the enthusiasm about IFRS 18 as much as we have on our side. So it's really great to hear that, and your commitment to the endorsement of the standard and the application of the standard is really the best way to start this educational session. So thank you very much for having us and giving us an opportunity to engage with stakeholders in India. That's very important to us. So thank you. So I'm here together, as you said, with Rowan Hasegawa. She's our project lead, and Deborah Bailey from our project as well. And we give you a first glimpse of IFRS 18 from the opening remarks. I understand that you know a lot about IFRS 18, but I assume that not everyone had the time to read every word. So we give you a head start in introducing the standard. If we'll go through, yes, the overview. So this is, as you know, this is a long project that was in the making. And the main driver of this project is investors. And investors have been telling us for a long time that there needs to be improvement in information provided about performance of the entity. It was in different kind of areas, but it took us some time, and we've provided IFRS 18 to respond to those challenges of investors. We believe that the standard would provide comparability, would provide transparency, and if I need to use my own words on what's the best thing of IFRS 18, I think it will provide a good communication between companies and users. It's not only users' benefit that are important to us, it's that communication that will be reached by applying the package of requirements of IFRS 18. If we move on just a little bit to introduce what we're going to discuss with you today. So IFRS 18 is a package of requirements, but we can look at 3 different sets of requirements. And we will go through each with Deborah and Rowan in a few minutes. But just as a matter of introduction, the first pillar is new requirements about subtotals in the statement of profit and loss, and including the operating profit subtotal. But in simple words, this is the requirements that will give us structure to the P&L. And it wasn't that there weren't any structure in the past, but the structure was different from one company to another company, make it difficult for investors to have a strong starting point for their analysis. So the requirements in IFRS 18 would provide a clear structure. Just to be clear, the structure does not mean uniformity, but it means to provide comparability and transparency, and that you can see when we further explain this. The other pillar is disclosure about management-defined performance measures. Investors were telling us that they love to see additional performance measures that companies want to provide to their users, but sometimes they get inconsistent information or they don't really understand all the adjustment. They wanted a bit more rigor and transparency into those specific management performance measures. This is a communication between a company and the users, and they wanted better information. Sorry, I have to move. Sorry, the light goes off here. So they wanted a bit more information about this means of communication, and the disclosure here will provide that to the users. And the third bit of the requirements is enhanced requirements about grouping of information. This is aggregation and disaggregation. So investors were telling us, look, sometimes the information is so aggregated, I have to go to the company and ask many questions. What is in there? And sometimes the information is so disaggregated, I cannot make sense of things. So we've created in IFRS 18, we can call it a framework, a judgment exercise to make decisions about when it is appropriate to group information and when it is appropriate to disaggregate information. And we believe this set of requirements, judgment, will provide better information to users. The standard, as already said, will be effective in 1st January 2027. We took a long time to think about providing sufficient time for entities to go through this process. Although this is a standard that is about presentation and disclosure, and the number of the total P&L would not change at all. It's not measurement, it's not recognition, but we realize this is important. We realize there are systems changes possibly, and the processes changes. So we provided sufficient time for entities to apply the standard, and we really believe it will deliver on its promise to provide better communication between companies and users. I think I will hand over now to Rowan to start with the first set of requirements. Thank you.
Great, thank you, Hagit. And as Hagit mentioned, the first set of requirements around categories and subtotals in the statement of profit or loss respond to investors' concerns about the difficulty in comparing financial performance because company statement of profit or loss often vary quite widely in their content and structure. So IS1 today requires entities to present revenue and profit or loss, but has no defined subtotals in between. So varying presentations have developed around the world as a result of that. And in some jurisdictions, there is regional comparability arising from local presentation formats or templates, as we understand is the case in India, while in other jurisdictions, practice varies quite widely. And the different variations in presentation among companies, even in the same industry, has been quite frustrating for users. So, for example, operating profit, which is frequently used subtotal today, has not actually been defined in IFRS accounting standards, resulting in various definitions of the same subtotal. So together with IFRS 18, we published an effects analysis, and in that effects analysis, we took a sample of 100 companies and noted that 61 reported an operating profit subtotal, but there are at least 9 different definitions of how that subtotal had been calculated. So to create a consistent structure for the statement of profit or loss, IFRS 18 introduces 3 new defined categories, as was mentioned earlier in the presentation. And these are operating, investing, and financing. and 2 new required subtotals to enable analysis, which are operating profit and profit before financing and income taxes. So to help explain the requirements for each of the categories, it's helpful to look at an illustration of what the statement of profit or loss will look like. As you can see on the right-hand side of the slide, this is the statement of profit or loss that's illustrated in one of our illustrative examples. And it's for an entity that presents largely their operating expenses here by function and one item by nature, which we'll talk more about that later in the session. The operating category at the top is defined as the default category. So that includes any income and expenses that do not meet the requirements to be classified in the investing or financing categories. And the subtotal of operating profit or loss will give a complete picture of a company's operations for the period, and all companies are required to present that subtotal, so it will provide a consistent and comprehensive starting point for investors' analysis, as Hagit mentioned. So the investing category includes income and expenses from investments accounted for using the equity method, as well as income and expenses from cash and cash equivalents and other investments that investors analyze separately to a company's operations. The financing category, together with the profit before financing and income taxes subtotal, will allow investors to analyze the performance of a company before the effect of its financing. This slide is showing an illustration for a general corporate, and we will talk later in the session about what the statement of profit or loss will look like for banks and insurers. There are special requirements for them as well. And just to note that this structure of the statement of profit or loss is generally aligned with how investors actually analyze the statement of profit or loss by splitting the income and expenses into those 3 categories of operating, investing, and financing. To take a little bit more of a deeper dive into each of those categories, if we could move to the next slide, please, Deborah. The operating category, as I mentioned, includes all income and expenses that are not classified in the other categories. It's the default category and therefore includes all income and expenses that don't meet the requirements for other categories, including those that are volatile or unusual income and expenses arising from an entity's operations. It's defined indirectly, and this indirect approach to defining operating profit works well with different business models and is simpler to apply than a direct definition, which may require significant judgment to apply. And the operating category includes, but is not limited to, income and expenses from a company's main business activities. And we'll talk a little bit later in this part of the presentation about entities with specified main business activities. But before we move to that, just to quickly cover what's in the investing category on the next slide. It includes 3 important income and expenses. So firstly, income and expenses from assets that generate a return individually and largely independently of other resources of a company. And those income and expenses include incremental expenses directly attributable to the acquisition or disposal of those assets. So for example, transaction costs or cost to sell those assets would also be included in the investing category. And examples of such income and expenses from these sorts of assets include rental income and remeasurements on investment properties and dividends and fair value changes on financial assets. So IFRS 18 also requires companies to classify income and expenses from all associates and joint ventures accounted for using the equity method in the investing category. This proposal or this requirement is strongly supported by investors who wanted the companies to classify the income and expenses from investments in associates and joint ventures accounted for using the equity method outside of operating profit. This doesn't mean that investors think that the result from associates or joint ventures is not important to a company's operations. In many cases, it is very important. However, investors explain that they use different methodology to analyze such investments because, firstly, they are not such investments don't have any revenue contribution, so they can have a distorting effect on operating profit margins of a company. They are not controlled by the company, and the share of profit or loss of associates and joint ventures is actually a post-tax and post-financing amount. So for those three reasons, investors were strongly supportive of the income and expenses from such investments being classified outside of operating profit. However, IFRS 18 does not specify where in the investing category a company presents the share of profit or loss of associates and joint ventures. So a company can present it directly after operating profit, followed by an additional subtotal of operating profit plus income and expenses from investments accounted for using the equity method. And finally, the investing category includes income and expenses from cash and cash equivalents, although, as we mentioned later in the session, some companies with specified main business activities will classify these income and expenses in the operating category. And finally, if we move to the financing category on the next slide, IFRS 18 requires a company to distinguish between two types of liabilities. So those that arise from transactions that involve only the raising of finance and other liabilities. To distinguish between these two types of liabilities, a company considers what's being exchanged in the transaction. So if a company receives cash and later returns cash, such as with a loan contract, then the transaction is a transaction that involves only the raising of finance. If a company exchanges something else for cash, such as in a lease liability that exchanges a right-of-use asset for cash, then it's an other liability. And for those liabilities that involve only the raising of finance, so as I mentioned, for a loan contract, the income and expenses classified in the financing category include income and expenses that arise from the initial and subsequent measurement of those liabilities, including the income and expenses that arise on derecognition and any incremental expenses directly attributable to the issue and extinguishment of those liabilities. So basically transaction costs that arise on initial or disposal of those liabilities. And for other liabilities, such as lease liabilities, only the interest expense and the effects of changes of interest rates are classified in the financing category. And examples of those liabilities are payables for goods and services received, decommissioning provisions, and pensions. Now, it's important to note that for pensions, it's the net interest expense or income on the net defined benefit liabilities or assets that would be classified in the financing category. And now I'd like to move to the next slide to just briefly touch on the requirements for entities with specified main business activities. So some companies provide financing to customers as a main business activity, for example, banks or insurers. In presenting income and expenses in a way that we've just described on the previous slide would result in these companies not being able to present key operating performance metrics such as net interest income and operating profit. So to address this, IFRS 18 includes requirements for such companies to classify specific income and expenses in the operating category that would otherwise be classified in the investing or financing categories. So if we move to the next slide, on the left-hand side of the slide, we have a statement of profit or loss for a company that invests in assets and provides financing to customers as a main business activity, such as an investment and retail bank. And as this company provides financing to customers as a main business activity, it includes in the operating category all income and expenses from liabilities that arise from transactions that involve only the raising of finance. And this allows the company to present its key operating performance metric of net interest income in the operating category. Interest expense and the effects of changes in interest rates on other liabilities, such as pension and lease liabilities, are classified in the financing category by all companies, which we can also see here in this example. And the company would not present the subtotal profit before financing and income tax because presenting the subtotal would be misleading when most of the income and expenses that would otherwise be classified in the financing category are classified in the operating category. The bank also illustrated invests in financial assets as a main business activity, so income and expenses from those investments in financial assets and income and expenses from cash and cash equivalents are classified in the operating category. And all companies are required to classify income and expenses from associates and joint ventures accounted for using the equity method in the investing category, so you can see them below the operating profit subtotal. And on the right-hand side of the slide, we've illustrated a statement of profit or loss for an insurer that invests in assets as a main business activity. The requirements work in the same way as the requirements for the investment or retail bank. Insurance finance income and expense and investment revenue, which is part of an insurer's key operating performance metric of net financial result, are classified in the operating category. However, the company illustrator does not provide financing to customers as a main business activity, so income and expenses that a bank classified in the operating category are classified in the financing category. And so this company is required to present the profit before financing and income taxes subtotal. So that is a quick whirlwind tour through the requirements for subtotals and categories. Deborah, can I now hand to you for the management defined performance measures, please?
Certainly, and good afternoon, everyone. It's great to be here today. So just to give you a brief run through about what management defined performance measures are. So management defined performance measures, which I will refer to as MPMs for the rest of the presentation, work together with the defined structure provided by categories and subtotals. So where the structure provides more comparability, MPMs will allow companies to provide more company-specific information about how management views the company's performance. And in many jurisdictions, companies use non-GAAP or alternative performance measures to communicate to their investors. And investors told the IASB that they find information about those measures useful. However, they said it was important that when providing company-specific measures of performance, it is important to be transparent about how those measures are calculated and how they relate to the requirements in IFRS accounting standards and when there are changes to those measures. So it is important to note that the scope of MPMs is limited to a specific set of measures related to the statement of financial performance. So we will talk more about the specific definition of an MPM, but on the right-hand side of the slide, you can see examples of some of the most commonly used non-GAAP measures. As MPMs relate to the statement of financial performance, measures such as adjusted operating profit will be MPMs, while measures that are not, such as free cash flows and return on equity, will not be MPMs. And this scope reflects the focus of the project on the statement of financial performance and desire to complete the project on a timely basis. So let's take a closer look at the definition of an MPM, and this definition is made up of three parts. So firstly, to anchor these measures to subtotals defined by IFRS accounting standards, the IASB has limited their scope to subtotals of income and expenses. So not all non-GAAP measures would be captured by this requirement, only those that are comparable to income and expense subtotals like operating profit. The second part of the definition is to provide a link with external reporting. Only measures that are included in public communications outside financial statements meet the definition of an MPM. And this is consistent with the objective to provide transparency to measures already used in communications and not define yet another set of measures. So public communications include management commentary, press releases, and investor presentations, but they don't include oral communications, written transcripts of oral communications, or social media posts. And then the final part of the definition will provide users with insight into how management views the company's financial performance. So only those measures that reflect that view are in scope. Management can overrule the presumption that a measure used in public communications reflects their view, and they can assert that only if it has reasonable and supportable information to do so. So, for example, a company might be required by regulation to include an adjusted earnings measure in public communications, but this measure is not used internally by management to make decisions and does not represent management's view on performance. So perhaps one of the most important things about the requirements for MPMs is that a company will be required to disclose information in a single note in the financial statement. And there are several key disclosures that are required for MPMs. So the first one is that it needs to be reconciled to the most directly comparable subtotal or total defined in IFRS accounting standard. The second thing is that the company needs to disclose a description of the aspect of financial performance that, in management's view, is communicated by the MPM. So that description will have to include an explanation of why the MPM provides useful information about the company's financial performance and how the MPM is calculated. And thirdly, if a company changes the calculation of its MPM or introduces a new MPM or stops using an MPM, it is required to disclose information about the changes. So what might a reconciliation look like? So here we have an example of how an MPM disclosure might look, and this example is also included in our illustrative examples that accompany the final standard. So one of the disclosure requirements for MPMs that is probably the biggest change for jurisdictions with requirements for non-GAAP measures is the requirement for a company to disclose the tax effect and NCI on each adjusting item. The example has been reconciled to operating profit and profit from continuing operations because they are the most directly comparable subtotals specified by IFRS accounting standards. But the IASB has specified other subtotals that a company can use in the reconciliation, including operating profit before depreciation, amortization, and specified impairments. It's worth noting that if a company does not disclose these specified subtotals in the statement of profit or loss and a company uses it in its reconciliation, a company will be required to reconcile to the nearest total or subtotal presented in the statement of profit or loss, but the rest of the MPM disclosures, like tax and NCI, are not required. So let's talk a bit about how we would go about calculating the income tax effects. So as mentioned, a company will be required to disclose the tax effect and the effect on non-controlling interest for each adjusting item in the reconciliation. And the reason why we're requiring this is that it gives investors the information they need to better understand the individual impacts of adjusting items, because investors have said that they want to be able to evaluate a measure by assessing the impacts of including or excluding the individual adjusting items and to assess the impact on a per share basis, which requires the effects of tax and NCI. So investors would like this information because they want to understand how MPMs have been constructed so they can assess whether those measures are sensible. So investors will take these adjustments through to their own calculation of the measure and particularly to the earnings per share measure. So that's why the effects of tax and NCI are necessary. So some participants, stakeholders said that calculating the tax effects of individual reconciling items may be costly. So to mitigate this, IFRS 18 includes a simplified approach to calculating the income tax effect. And that is based on the tax effects of the underlying transactions at the statutory tax rates applicable to the transactions in the relevant jurisdictions. A company would also be able to choose to calculate the tax effects on adjusting items on the basis of a reasonable pro rata allocation of current and deferred tax in the tax jurisdictions concerned, or by another method that achieves a more appropriate allocation in the circumstances. So these alternatives will provide investors with a reasonable estimate of the income tax effect of adjustments, making it clear when the tax effects of an adjustment are materially different to the effect calculated applying the company's effective tax rate. So companies will have a choice on which method of calculating tax to use for each reconciling item, but companies will need to disclose the method they have used. So after that whirlwind tour of MPMs, Roanne, can I hand back to you for the requirements in IFRS 18 around grouping of information, which is otherwise known as aggregation and disaggregation?
Sure, thanks, Deborah. So these requirements, as Haggy mentioned earlier, respond to investors' concerns that often information in the financial statements isn't grouped quite at the right level to provide the most useful information. So some companies don't provide enough detailed information about important transactions. For example, there are often large balances labeled simply as other with no additional information. And in other cases, there's excessive information about unimportant transactions, which can actually obscure the information that investors are looking for. So IFRS 18 responds to those requirements by introducing a suite of guidance to help companies judge the level of grouping that is appropriate for their circumstances. So these requirements include requirements for presenting and disclosing operating expenses, guidance on whether information should be presented in the primary financial statements or disclosed in the notes, and disclosures about items labeled as other. So if we move to the next slide. One of the key parts of these requirements for disaggregation and aggregation is to define the roles of the primary financial statements and the notes. The role of the primary financial statement is to provide structured summaries of a company's recognized assets, liabilities, equity, income, expenses, and cash flows that are useful to investors for obtaining an understandable overview of those items, making comparisons between companies and between reporting periods for the same company, and identifying items or areas where investors may wish to seek additional information in the notes. So this role of the primary financial statements we refer to as a concept of useful structured summaries, or useful structured summary for each individual primary financial statement, and they will help a company to decide what information to present in the primary financial statements and then which information to disclose in the notes. And it's important to note that the concept of useful structured summary is applied to all primary financial statements. So though IFRS 18, the other requirements are focused on the statement of profit or loss, these disaggregation and aggregation and the concept of useful structured summary that it's newly introduced is focused on all the primary financial statements and the notes. Not all material items can be presented in the primary financial statements because it would result in the primary financial statements becoming very, very detailed. So the concept of useful structured summary is a higher level of aggregation that's required for items that are presented in the primary financial statements. However, the role of the notes is then to provide the material information that's necessary to enable investors to understand the line items that have been presented in the primary financial statements, and then to supplement the primary financial statements with additional information to achieve the objective of financial statements. Importantly, the role of the notes is to make it clear that if disaggregated information would be material, the information is required to be disclosed in the notes. We move to the next slide. There are some additional general principles for aggregation, disaggregation, and the use of meaningful labels. So a company will be required under IFRS 18 to aggregate items based on shared characteristics and disaggregate items on basis of characteristics that are not shared. So a single dissimilar characteristic can be enough to require the disaggregation of an item if the resulting information is material. Aggregation and disaggregation in financial statements should not obscure material information or reduce the understandability of the information presented and disclosed. So to help a company apply the principles, IFRS 18 provides application guidance on how to aggregate and disaggregate information, in particular which characteristics to consider, whether items have similar or dissimilar characteristics. And so one example of the characteristics a company would consider when aggregating or disaggregating income and expenses is persistence of that income and expense. And that includes the frequency of the item of income and expense, or whether it's recurring and non-recurring. IFRS 18 also includes application guidance on how to describe items presented or disclosed to represent them faithfully, including how a more informative label can be provided. So instead of simply labeling something as other, it could be labeled as other operating expenses or other operating income. A company only labels items presented as other if it cannot provide a more informative label. And if there is not a more informative label for aggregated items, then a company should use the most precise label as possible. And if the aggregation comprises items that are not material, but it's sufficiently large that investors might reasonably question whether it includes information that is material, a company is required to disclose further information about that amount. So for example, if the aggregation of items is not material, then disclosing that the items contained within are not material is actually material information, because that information will resolve investors' questions about whether they need to know more about that item. We move to the next slide, which talks about the disclosure of specified expenses by nature. I'd just like to mention that a company is required to present operating expenses either by their nature or their function within a company. And it's possible to present some line items by nature and other items by function if that provides a useful structured summary of the entity's income and expenses. So the profit and loss statement that was illustrated earlier on slide 7 is an example of a company that presents most line items by function and impairment losses by nature. And my understanding is that by nature presentation has traditionally been used in India. And so just like to highlight that the illustrative examples that we issued together with IFRS 18 also contain an example of a company that presents its operating expenses by nature. If a company presents one or more operating expense line items by function, it's required to disclose the amounts of specified nature expenses included in each line item in the operating category. And the 5 nature expenses that are required to be disclosed as shown on the slide: depreciation, amortization, employee benefits, impairment losses on non-financial assets, and write-downs of inventories. It's important to note that the amounts to be disclosed are not required to be amounts recognized as an expense in the reporting period. However, if the amounts disclosed include amounts that have been recognized as part of the carrying amount of an asset, a company shall give a qualitative explanation of that fact and identify the assets involved. If we move to the next slide, we actually illustrate here the specified expenses by nature, what that note would look like. This is illustrated in our illustrative examples that were issued together with IFRS 18. In this illustration, the amounts disclosed are those recognized as an expense in the statement of profit or loss for the year, except for depreciation and employee benefits. So the amount disclosed for depreciation is the charge for the year, applying IAS 16. And the amount disclosed for employee benefits is the cost incurred, including pension costs for employee services, applying IAS 19. The amounts of depreciation and employee benefits include amounts that have been capitalized by including them in the amount of inventory at the end of the reporting period. So that's it for aggregation and disaggregation. Deborah, would you like to now talk us through the limited changes to the cash flow statement?
Yeah, certainly. So in addition to IFRS 18, the ISB has also amended IAS 7, which is the standard concerning the statement of cash flows, to introduce 2 changes to the statement of cash flows relating to operating cash flows and the classification of interest and dividend cash flows. So in current practice, companies use different starting points for the indirect method for reporting operating cash flows. And it's my understanding that in India, EBITDA was a traditional starting point. But investors have indicated that this diversity in practice reduces comparability between companies, which makes their analysis difficult. So additionally, the accounting policy choices currently permitted by IAS 7 for classifying interest and dividend cash flows have caused diversity in the classification of those cash flows. And this diversity is present even between companies in the same industry. And as you would have guessed, this diversity reduces comparability and does not necessarily convey information about the role of interest and dividend cash flows in a company's business activities. So to reduce all of this diversity, the subtotal operating profit or loss is now the required starting point for companies applying the indirect method for reporting cash flows from operating activities. And to reduce the classification alternatives that are currently permitted and to ensure comparability, a company will be required to classify interest and dividends paid as cash flows from financing activities and interest and dividends received as cash flows from investing activities. So dividends received, interest paid, and interest received are classified in a single category. So the entity can choose whether it's operating, investing, or financing activities in the statement of cash flows by a company with specified main business activities. So having said that, Hagit, could I hand over to you for closing of the last part of our session, please?
Thank you very much. Thank you, Rohan and Deborah, for going through the details. And then I'll try to pick up the educational session with a few more slides. So on slide number 28, If we can go there. Yes, thank you. So if you look at IFRS 18 and the package that we've published, you'll see other documents as well. So let me just put some order in the things that you see there. So IFRS 18 is replacing IS1, presentation of financial statements. There are some requirements that have been moved from IS1 to IFRS 18 without a change, only editorial changes. So some requirements remain there, but there are the new presentation and disclosure requirements that we've introduced today. It is important to note, and we've noted this before, the requirements of IFRS 18 will not change how companies recognize and measure items in the financial statements. It is mainly about presentation and disclosure. It doesn't mean it is easy. It doesn't mean it is not important, but we need to understand the context of things. This is presentation and disclosure requirements. There are also amendments to other IFRS accounting standards, such as the amendment to the cash flows that Deborah mentioned, and other amendments that were consequence of IFRS 18. As we pack up, let us remind everyone that the effective date of IFRS 18 is 1st January 2027. Companies are allowed to early apply the requirements of IFRS 18. And IFRS 18 is applied retrospectively, including in interim financial statements. And retrospective application is important because investors are looking at information and they would like to compare between one period and the other and understand the trend information. This is why we've allowed extended time until the effective date so companies can work through the amendments and the changes and apply the requirements retrospectively. Also important to note that there would be transition disclosures, so a reconciliation between the old P&L and the new P&L to explain the changes for the users and the first year of application. This would apply to interim and annual financial statements as well. And I think this brings us to the end of the education session. I hope it was useful to you. And thank you very much for the opportunity to share our thoughts on IFRS 18 with you. And let's see if we have any questions that you want us to address. I don't know, Deborah, whether you received some questions for the team to address.
I haven't got any questions on my side, but perhaps our colleagues at the ICAI would have some questions for us.
We'll be taking that during our panel discussion, just after that. And of course, Hagit would be remaining there as a panelist. Right?
Okay, thank you very much. Our pleasure to present to you and my pleasure to join the next panel. Thank you.
Thank you very much, Hagit, Rowana, and Deborah, for an excellent presentation. And yes, very rightly said. And for the members at large, industry at large, there is no change in the measurement principles, only the presentation and the disclosures. That is the only there. And of course, after this excellent presentation on the IFRS 18, where we talked about the changes in the profit loss and the cash flows and the related impact. Now, let us go for the panel discussion thereafter. And for that, we have, of course, apart from Hagit Karim, we have got our own past president and also the past chairman of the Accounting Standard Board, CA Manoj Fadnisji. He was the president in 2015-16. And of course, his passion is Ind AS. I suppose it is in blood, because every time we talk about accounting standards or Ind AS, we know Manoj Fadnisji is there. Welcome, Manoj Fadnisji, to this panel discussion. And also, we have got another, I would say, a very, very learned and very dear friend, a stalwart, I would say, in the accounting standards in India, CA MP Vijay Kumar, who has been the past chair of the Accounting Standard Board. And also, he is a member of the IFRS, the IFRS Interpretation Committee representing India. So great. And whenever we hear both Fadnisji and MPV sir, we know that they know from the base So the concepts are very, very clear. Thank you and welcome, MPB sir. And also we have another panelist, Amrita Shrikantji, who is a vice president and heads the technical accounting and revenue assurance as well as the sustainability reporting in one of the India's largest software company, Infosys India, I would say world over most probably. And of course, she is also the member of the Global Preparers Forum, which is an independent body from the International Accounting Standard Board as well as the IFRS Foundation. But of course, the main intent of that forum is to give the inputs to the international community. And to moderate all these starwards, these four panelists, we have got C. Archana Bhutaniji, again, who is an avid person in the arena of accounting standards and the INDAS. Again, she's again a co-opted member of our board. So over to Archana Bhutaniji for a healthy panel discussion, keeping in mind, of course, in India, when we'll be doing it, IFRS 18 into INDAS 18, we have to work a lot in ASB as well as with the regulators ministry to get that implemented, the formats. Everyone in India knows about that, how that is going. So over to Archana, please. Thank you.
Thank you. Thank you. And a very good afternoon to everyone. It's a pleasure and privilege to be part of this panel and moderate the discussion with such esteemed members. Thank you, Haggett and the team, for such a comprehensive overview. Before I get into the panel discussion, I just want to reiterate the point you've already made, that the IASB has issued a lot of standards, new standards in the last decade, but they've focused on recognition and measurement. We saw revenue recognition, we saw leases, but very little was done to improve presentation requirements. And as a result, the income statement under IFRS has been rather form-free. So I totally agree that in that context, IFRS 18, it represents one of the most significant change to the company's presentation of financial performance since IFRS standards were introduced, nearly 2 decades ago. So starting with the discussion, I'll first start with the MPV, if that's fine. MPV now, we spoke about the fact that there are 3 subtotals and there are new categories of, the new categories to be presented. Like I said, IAS 1 has been form-free in the past, but these categories will come in. So do you think it will bring in consistency in terms of presentation and also maybe comparability? And how does this interact with the ability of a company to tell its own story, or with the fact that, different companies will have different nature or different size?
Thanks, Archana. I'll just take 10 seconds. I want to thank ASB of ICI and in particular Chairman Pramod Jain for the invite to be here today as part of the panel. I think it's extremely important to recognize that this standard, which has been issued after a lot of effort and time, as Haggett mentioned, it was actually issued on 9th of April. And I was fortunate enough to be present at as part of the IFRS Advisory Council meeting that day when this was launched. And I could see the joy in the face of all the IASB members, including Andreas and the staff, when this particular document was published. And exactly less than a month, today, 8th, we are having this outreach meeting in India. Pramod Bhai, thanks for taking the lead, and also thanks to Haggett and team for your time and the wonderful presentation which you have done today. Standard is a very welcome standard, Archana, as you just mentioned. It was long overdue, as you also articulated so well, that the last 2 decades, we have seen IFRS focus on a lot of recognition, measurement-related standards. Of course, we had a disclosure standard in the form of IFRS 7, but that's a relatively lesser one. But in terms of income statement, an attention was pending, and it's finally here. I'm not too sure about the other jurisdictions, but as far as India is concerned, we have been extremely fortunate that we always had a form for companies and other regulatory sectors like banks and insurance companies. And in the context of companies, the form was developed based on the principles which were there in IAS 1. So for India, in that sense, transitioning into IFRS 18 is a relatively lesser task. I don't know how many other jurisdictions have that benefit, but in India, at least, we have that benefit. And the new presentation format which is required is not substantially different from what we have now, except that we have confined it to the nature of expenses alternative when it comes to the operating expenses presentation category. What has enabled for India over a period of time, having a form, and I'm happy that globally we'll have a form for income statement, is both inter-firm comparison and intra-firm comparison. I think both have been very, very useful for the investor community. Even at the cost of repetition, I know Haggett mentioned it 2 times, and Chairman Pramod Jain ji just mentioned it as part of his remarks before he handed over to the panel. But I want to highlight it once again, because in most forum, this will be the one which people will have a wrong understanding. So I want to reiterate it. This IFRS 18 will have no effect whatsoever on the measurement of the financial performance. It remains status quo. The financial performance, the final figure of profit, nothing undergoes, no change happens at all. The change is only with reference to an improved, a better presentation and disclosure for understanding for the management, for the board members and the investors. While the standards are prepared or drafted keeping investors in mind, but being an executive myself and being part of several boards, I know that we also many times do this inter-firm comparisons, and we would like to have financial statements which look very, very comparable, and we can make meaningful sense by looking at inter-firm comparisons. The good part of the standard is the requirements are pretty simple. They're not complex. They're very, very simple. It's unlike the standards going back. It's not like 17, IFRS 17 or 16 or 15 going back in those series. It's not difficult like those standards. It's relatively light on reading. Almost a significant part of IAS 1 comes as is here. So you don't feel like you're reading something, a new literature. It's almost like you're continuing reading IAS 1 with the right kind of improvements which have been brought in here. For me, what is exciting in IFRS 18 is 2 things. Standardization of a key measure, namely operating profit. In fact, many of us use different terminologies of profit, and one of those most commonly used profit measures is EBITDA. And I think Deborah mentioned, I think, that India uses EBITDA. We don't use EBITDA as far as our reporting is concerned, Deborah. It's basically the investor and other community who uses it. It's not part of the published financial statements, not a permitted metric, because we all know that this is a measure which is not so very well defined and people use it so very differently. So now with IFRS 18, we'll have this beautiful metric called operating profit. And for me, in particular, after IFRS 16 had come, where leases also you account as right of use assets, and the usage of the asset cost, which is depreciation or amortization hitting the P&L. The more relevant metric of profit is operating profit. Just like men, materials, machines is also a cost. How you fund it is a different matter. But machines, the usage cost of machine is a cost. and that usage cost is depreciation. And the right measure of profit of a business is the operating profit. Managements will, of course, now have the freedom to continue to have alternate measures which they would like to communicate to the investor community, EBITDA, adjusted EBITDA, whatever terminologies. But ultimately, they'll have to reconcile it with a line item like operating profit. My view, this is one big transformational change and a very welcome change. The second good thing is just like IFRS 15 ensured that world over, the revenue number, which is a very important metric to understand an organization, a business performance. With IFRS 15, we have more or less achieved a consistent way of recognizing, measuring, and understanding revenue. The next important thing was profit. And I think with this term operating profit, I think we'll achieve that goal where almost the whole world will have this number called operating profit, which will be a very, very comparable number. I think that's a great achievement we'll have. And the P&L is going to be presented in a way which will have 3 plus 2, 5 buckets. 3 plus 2, 5 buckets. The 3 comprising operating, investing, financing, and discontinuing and taxation. 5 elements, 3 plus 2, 5 elements. Operating, investing, financing. It might tempt us to believe it is similar to what we have in cash flow statement, but it's not necessarily so. But it's so closely aligned, and most of us rely so much on cash flow statement, and particularly when we want to understand business, we look at operating cash flows. Now, this format of income statement with operating category as a profit and operating profit, I think it will be such a welcome change for every user of financial statement that I'm sure that this standard will be one of those most popular standards and most welcome standard. And in this particular standard, Archana, the other important thing which I'd like to highlight for the benefit of all is after the operating category, we have this investment income, with typically the associates and joint ventures. And it's important to bring it to all the stakeholders' attention that when the standard was initially developed, we were looking at categorizing this investment income as integral and non-integral kind of a breakup. But there's so much of feedback, including from India, and credit to IASB, and also the quality of inputs which have come from across the world, that all these inputs have been so very effectively deliberated. And on balance, it was felt that let's drop this integral, non-integral one, while it actually has a purpose to achieve. But I think on balance, it reduces the conflict of breaking our head into integral, non-integral and all, particularly having done away in the context of foreign currency. I think we need to give credit. And I would like all the stakeholders to understand that the feedbacks actually get deliberated and they get acted upon. It's not like standard has been developed and dumped on us. And there's a classic example of such a material item. And feedback has come from several stakeholders, including from India. And that feedback has been incorporated. It talks about the robust process which actually goes through in the process of development of these standards. I'm confident that all the regulators with ICA's active engagement, MCA, RBI, and IRDA, will work on developing the revised formats so that they are in close sync with IFRS 18. We will have our own Ind AS 118, and I look forward to that happening soon.
Thank you so much. If I could just take the opportunity to just add one comment there. I think you and everybody's already talked about the categories and the operating profit. Just one bit which I wanted to add here. Usually, and my understanding is usually, you look at the expense by the nature of business and, based on the nature of business, you'll classify the expense into these categories. one bit which I just wanted to highlight because it's a key area of interest is your foreign exchange fluctuation. The way I understand is that is now going to, in a way, get disaggregated. So to the extent my foreign exchange fluctuation relates to sale of goods, I will take it into operating. To the extent it's on loans, I'll take it into financing and so on. And similarly, there are detailed requirements for classification of gains or losses from derivatives and designated hedging instruments, which may change. So I thought I'll just mention this. Thank you so much, MPV. Moving on to the next one, Mr. Furness, if I may come to you. Even MPV alluded to the fact that, when we talk about investing, operating, the first thing that comes into our mind is the cash flow statement. So are these categories in IFRS 18, how do you think they're aligned with the corresponding categories in the statement of cash flows as per IAS 7?
So thank you very much, Archanaji, for that question. And let me also thank the chairman and the vice chairman and the entire ASB team for this wonderful discussion on IFRS 18. And as MPV just mentioned, within 1 month of its launch, we are discussing this in a webinar in India. So kudos to the ASB and the great support which ISB is extending to the institute. So it's a pleasure to be a part of this important webinar discussing on this new standard which has just been launched. And very shortly, I'm sure the ASB will also come out with the Indian version of IFRS 18, which would be Ind AS 118. Given the fact that, the way Hegget and her team explained the standard, I'm sure a lot of doubts would have been cleared for everyone. And thanks to the wonderful extension of that done by MPV, further explaining the standards in the Indian context, what we need to understand and what we did not really fear about. So in that background, coming back to the question that you asked, and the fact that for the first time we are going to have the statement of profit and loss dissected into these 3 categories, the way we have the cash flow statement. As MPV also mentioned, we have a statement of profit and loss which is notified in our Schedule 3 to the Companies Act, which is by and large based on IAS 1. So really speaking, for the Indian companies, it should not be too big of a problem to adopt to Ind AS 118. Given the changes which have been made in the new standard. Also, the fact that we do not have a format for cash flow the way we have it for a balance sheet and statement of profit and loss. What has been very popular in India is the indirect cash flow method of preparing the cash flow statement. And we had this starting point as profit before taxes, which with the amendment in IAS 7 becomes a starting point, becomes the operating profit. Now, if the profit and loss statement is also to give these 3 sections, operating profit, investing, and financial profits or losses, for an investor or for a shareholder, a stakeholder to understand and correlate between the statement of profit and loss, so what has been the operating profits and what is the operating cash flow, would be much easier to understand. And in that sense, I believe this would be a welcome step in understanding what are the operating profits and what are the net cash inflows or outflows from that particular activity. As one of the examples which you just mentioned about foreign exchange differences, so very rightly, if it is arising from the imports and exports, so those foreign exchange differences would go as part of the operating profits. But if it is a part of, say, any of the investing activities or financing activities, it would go in the respective categories. So to that extent, there would be more refinement in way the profit and loss statement is presented and how the cash flows are to be related to it. So by and large, I believe this is a good alignment and would help the investors and the stakeholders in better appreciating the financial statements.
Okay, thank you. Thank you so much. Amrita, if I can come to you now. We spoke about the categories but I also wanted to talk about whether there is any change in the overall approach for classification of expenses. we spoke about by function or nature. Would there be a change when we move to IFRS 18? And if you can also talk about, the steps a company can take to effectively comply with the requirements and, improve the comparability and transparency of information in these financial statements. So
Sure.
2 questions.
Thank you, Archana, and good afternoon, everyone. I also would like to extend my thanks to the ASB of ICAI, the chairman and the vice chairman, for inviting me to be a part of this panel discussion. It's really a very wonderful opportunity to hear all of you. And of course, thanks to the IASB for taking time out and for explaining it in such a lucid and very, very clear manner. So, as MPV sir was saying, I was also part of the discussions which we went through as a part of this IFRS 18, as a part of the Global Preparers Forum. And I've seen the journey from where we started as the exposure draft and where it has finally ended up. And there's been a tremendous amount of work and efforts that have been put in by a lot of stakeholders, a lot of comment letters, a lot of opinions that have been expressed and which have been considered and acted upon. And what we see today, that's the final end product of this IFRS 18, is the sum total of all these efforts that have gone through. And I must say that it's a standard which we all are really excited to implement, a standard which we are sure is going to achieve the purpose for which it has been drafted. So having said that, I just want to take a step back and see that what exactly do we, when we say the role of the primary financial statements, what exactly do we expect a financial statement to present to the users? So one is, of course, the users are going to get an overview of what is the company's assets, the liabilities, equity, income, expenses, cash flows. It helps in making comparison between the various entities, both intra-companies as well as within the company, between the various reporting periods of the same entity. And it also gives us ideas or areas for the user to identify which are the areas in the financial statement where they may need additional information for which they go back to the notes or the schedules. So keeping this background in mind, and if we have to go back into the IFRS 18, what exactly IFRS 18 focuses on, and of course, the cost of repetition of what the other panelists have already spoken about, we have the statement of profit and loss account, which is now going to be categorized again into operating, investing, and financing activity, and 2 new subtotals that MPV sir spoke about. Now, this standard is going to clearly call out what is going to fall under the investing and the financing category, and that makes the operating category a residual category. So it was after a lot of deliberations where ISB decided that they will not define what exactly is going to sit under operating category, because that's going to make it very difficult when you look at the wide spectrum of industries that are there and the various expenditures that can fall under the operating categories. So operating category is now a residual category, whereas it is the standard clearly calls out what is investing and what is financing activity. Now, one interesting part or something which we will need to look at it a little bit differently is that an operating activity will include both the usual business activities as well as anything unusual that would have happened during that particular period. So even that will go and sit under your operating activity. This as a whole, this whole idea of making this easily readable and easily comparable is what is going to be really, really a welcome step as far as the investors and the users are concerned. Now, one of the podcasts I heard ISB mentioning that 2/3 of the companies provide operating profit as a subtotal, but there are 9 different ways of computing it. So I mean, we can imagine the amount of disparity that is out there. So by defining these subtotals and where operating profits has been really called out, it's again going to really help in bringing in uniformity and comparability of various financial statements across the globe. On the management performance measures, it's going to increase the transparency, and investors will also understand how these measures are computed as compared to the measures as defined by the IFRS accounting standards. Now, investors rely heavily on these management performance measures because these management performance measures today it's something like what we call as an alternate performance measures, or what we call as non-GAAP. But these NPMs, which are now again defined in the standards, which will again have a reconciliation and a walk through back to the P&L items as prescribed under IFRS, will give investors insight on how the management views the company's financial performance, how the company is going to be managed, how the company is getting managed, and how the financial performance is developing. Now, on the classification of expenses, right, whether it is going to be, what exactly are we trying to achieve by doing this classification of expenses? We are going to provide more useful information to the investors. And as a company, we need to step back and think what line items actually provide useful information about the drivers, the important drivers of the company's profitability. What are the line items that we want to focus on? And what line items clearly represent the way the company is managed and how the management reports or looks at things internally. So whether we are going to present this operating expenses by nature or function, I understand it's going to be largely defined by how we in India decide to move forward on this. We are already there nature-wise, so would we want to move function-wise, or will we continue doing nature-wise is something which we have to wait and watch. But globally, when a lot of companies are doing it function-wise, and we are also bringing in an aspect of getting nature-wise into it, where we are going to have an hybrid now. Certain items get classified function-wise, and there could be few things like your impairment loss, goodwill impairment loss, and things like that brought in the P&L as a nature-wise expense. This is going to give a very, very different look to the way the P&L would look. So this is something which we need to wait and watch. We need to wait and watch how we in India are going to move towards it. But at the same time, it is very important for the companies to spend that much amount of time and energy in trying to understand and in trying to establish what are the line items that we really want to focus on. What is it that we want the users of the financial statement to really understand as far as the company is concerned, and to get a very good background or an idea of what the company's performance and operations are actually pertaining into. And last but not the least, when we are talking about the disaggregation, the label others, right, the other expenses, which we generally tend to fit a lot of things into, that will need to be relooked at to see whether anything needs to be culled out, anything which is material needs to be pulled out and needs to be disclosed separately. Or, as Hagrid mentioned, do we need to say that the items which are sitting over there are really immaterial from a company's perspective? So it doesn't really matter whether they sit under the category of other operating expenses. So see, these are some of the areas where I think we really need to, as a company, we would need to focus on, and we would need to deliberate on and spend time on.
Thank you. And if I can maybe one final point, which I can maybe just highlight since we have the ISB here. The way I understand the standard, unlike the previous IAS 1, wherein there was somewhat a discretionary option to do functional and nature, here it doesn't seem to be as open-ended. It seems you need to see which one is more appropriate. And I think to that extent, the option is not that, open. And in that context, Amrita, I think what you mentioned about how India will have to work on this will require discussion in terms of our convergence process. So yeah, thank you. Hagit, I'm going to come to you now. This is one question which I'm sure many really want to ask, while Amrita has also referred to it and you also covered it, is the unusual item. I appreciate what MBV said, the IASB was very receptive to feedback. They've taken that into account. They made some changes and so on. But one of the things that the initial draft had was a definition of unusual item. I understand the stakeholder feedback presented different views, and probably that is why IASB did not proceed with it. Now, in India, the unusual item, I'm going to just use a term which we use here. It's not defined as the exceptional item. It is quite often used. So how would the fact that there is no concept of unusual item, you mentioned that this will be part of your operating category. How does this impact the existing practices? If a company does want to show a profit or a subtotal before or after this, does it still have the ability? I understand we've got MPM. Would MPM be the only route? Just thoughts in terms of why this was not included and how a company can probably disclose these items better in the new standard.
Thank you very much, Archana. And just before I respond to your question, just to let me say thank you for allowing me to participate in this panel. It's been a true inspiration to listen to the other panelists being very knowledgeable about the process and the product, being very much connected to the practice, and very enthusiastic about IFRS 18. So thank you for that again. And to respond to your question, yes, unusual items, that has been an item of discussion for a long, long time. So I think it was clear to us from the messages that we received that everyone wants this to be defined. But in order for us to do proper standard setting, we need global support. And there was no global support for one definition that is truly understood and accepted by everyone. So at that point in time, we've decided not to continue with defining unusual items. But it doesn't mean it's not important. The mere fact that you say you use it, and I know in other places it's been used, it means that it is important not to prepare us, also for users. So it is important, and we acknowledge that users would like to learn or understand more about unusual items. And I think IFRS 18 package of requirements give you different routes on how to provide this information. So it could be, if we look at the aggregation and disaggregation requirements. So as we said before, those requirements are really a set of judgments that you need to apply. Aggregation and disaggregation is looking at different characteristics. And if we have, for example, a line item with a lot of different items in it, and you go to the notes, and there's one amount there that is different in its characteristics because it's not a recurring item, it might mean that you need to, not just want to or opt to, you need to disclose it separately because of the requirements about aggregation and disaggregation. So we will see this information definitely in the notes if it makes sense and it works with the aggregation and disaggregation requirements. Another point to consider is the labeling. So we said that we need to use labels that provide information about what's in there. If the label wants to describe that there's something unusual, it will say it is unusual and why it is unusual. So we have a better communication between the company and the users, of course. You mentioned presentation. So if you look at the requirements, it's not impossible for an unusual item to be a line item in the P&L. But for something to appear in the P&L, it's not just aggregation and disaggregation requirements. There's a different hurdle about providing useful structure summary. And there is already a structure that is in place for IFRS 18 with the categories and everything. So it needs to fit to the structure of the P&L, and it needs to provide useful structure summary of income or expenses. I think, to be honest, we would expect this information to be more common to appear in the notes than on the face of the P&L, but it's not impossible. This is something to think about. And also, as you mentioned, another tool that is not optional, but is there as well, is the MPM. If a company already communicates with its stakeholders about unusual elements, as you said already, and obviously it is important for users, if this is included in different KPIs, MPMs outside financial statement meets the MPM's requirements, then we will see the disclosure under IFRS 18 that tells us exactly why a company has a different view or wants to show the user a different view of its performance, what kind of expenses or income are used to be adjusted, so an investor would understand the company's thought process and understand whether they have been consistent throughout the periods with how they identify what is unusual for the company's point of view. So I think we have enough in IFRS 18 to give this message. So it's not that it's not important, it's very important, but it's different tools rather than a definition of an item. Thank you.
Thank you so much. That's very, very helpful. We've been talking about MPMs. I think I'd like to move on to that now. Mr. Pandit, if I can come to you, what are your views on the concept of MPM? Do you think it will help users in understanding why these measures are used and how they are calculated? And do you expect these to be used widely effectively? What are some of the checks and balances that may be required?
So it's good that MPM is now being brought in, and there is a requirement specified in the standards. If you look at it from the auditor's point of view, before we had the standard SA 720, where the auditor is required to look into the other matters reported in the annual reports. Before that standard really became effective, there was a time when many cases it would happen that, say, for example, the segments, as we had in the earlier standards, the segments which are disclosed in the director's report or in management discussion and analysis may not be in agreement with the auditor in the audited financial statements. And given that background, when SA 720 became effective, the auditors also started looking into the other information and reporting on that. When you come to management performance, I believe it is good in the sense that the management is now required to give a reconciliation with what is reported in the financial statements, and therefore it becomes auditable. Some of the performance measures which are based on financial statements are easy to verify from the auditor's point of view. But certain non-financial measures which are reported or which are communicated by the management to the investors, such as, let's say, the number of customers is one of the examples. So maybe the number of customers can be totaled up and it can be identified and it can be verified. But if it is customer satisfaction, so that becomes very difficult for an auditor to really verify, and there is no basis to verify that. So in that sense, I believe this is a good development, and I'm sure the management would like to communicate in different ways the performance to the investors, and this kind of standardization would help all.
Amrita, would you like to add anything more from your preparer's perspective?
Yeah, sure, Archana. So the way we would look at a management defined performance measure is something which, which is now getting defined as a subtotal of the income and expense, which the company would use in public communications outside the financial statements. And we say public communication, we talk about documents like your press release, investor presentation, so on and so forth. And oral communication is thankfully now kept out of this. This is MPM is what the entity would use to communicate to the users of the financial statement what is the management's view of the financial performance of the entity. And naturally, it's not going to be something which is defined in the either in IFRS 18 or in any other GAAP. So these measures are such that the company believes that it is essential for the investor community and the users to understand the actual performance of the company and to get insight into how the management views the financial performance, how the company is managed, and how the financial performance is developing. So naturally, MPM becomes very important from that perspective, from the commentary which the company wants to give as far as the investors are concerned. Now, does this mean that all non-GAAP that we are going to talk about will become an MPM? No, because as we already spoke about, MPMs are limited, or they are only at the level of the subtotals. So in our industry, like for example, constant currency revenue growth is something which is a very common non-GAAP measure, which all of us talk about, but that's not going to be an MPM. So that's going to still continue as a non-GAAP measure. Now, would it help in understanding why these measures are used? Yes, of course, because now the users, it's going to take the users one step ahead, because companies are now going to have to explain why they have used these measures and how it ties back to the IFRS P&L. So it is going to help the investors' ability to compare the performances between the various reporting periods for the same company as well as between companies. And it's also going to be very important as far as the investors are concerned to understand how companies measure their own performance. Companies will now, it's like a tightrope now, companies will have to strike a balance on deciding how much of these MPMs they will need to disclose, how much is going to be reported, how frequently, and with what consistency. Because too much, I believe, would defeat the very purpose of having a uniformity across financial statements. If there are so many MPMs out there in the market, it defeats the whole purpose of having a common uniform financial statements across companies. Again, we spoke about unusual items. If they're really unusual items which the company wishes to draw attention to, then we will have to explore and think through whether we would like to call it out as an MPM and give more details about it. The reconciliation of the MPMs to the standard, to the IFRS 18 standard, as well as to the how the previous P&L would have looked like. That also becomes very important, especially when we are getting into the transition zone. So I think MPM is a very good measure, but at the same time, it's very important that we maintain a balance and we don't go overboard as far as MPMs are concerned.
Agit, can I maybe just take the benefit of your inputs here? How does EBITDA fit into the entire, requirements? And the ISB is also specified operating profit before depreciation, amortization, and specified impairments, what you call OPDAI as a subtotal, which is not MPM. Can you just talk about that, and maybe how does EBITDA fit into the overall requirement?
So I think, sorry, I thought you were.
No, please go ahead. Please go ahead.
No, that's okay.
So Agit, this was, if you can, yeah.
Okay, it was for me. Sorry, I thought I misunderstood you. Yes, so we had several requests about EBITDA, and I think Vijay also mentioned it. And I think we have now a new measure. And as you just said now, Archana, we also have mentioned the specified subtotal that is looking like EBITDA, but it's not exactly the same because it really depends. Interest income for different companies can come in different places in the P&L. It's not exactly the same as EBITDA, but I think companies might use EBITDA as an MPM, and then they could reconcile it to our specified subtotal or the closest one. So it is an attempt to get to something close, but within the structure and the discipline that we put around the P&L, so it doesn't get too loose. Okay. I hope I answered your question.
Absolutely. I'll move on to the next category of changes, which is the aggregation and disaggregation requirements. And maybe I'll come to you now. What judgments do you think could be required in deciding the appropriate level of aggregation and disaggregation? I mean, if you could just talk about that a bit, and how do you see this impacting the existing practice and implementation challenges, if any?
Okay, the last part of the question is easier, Archana. We have the benefit of the regulators guiding us through that aggregation and disaggregation process as far as India is concerned, and I think they'll continue to play that role. So that part is a relatively easy one. But I just want to spend 30 seconds for understanding aggregation and disaggregation requirement by drawing reference to the role of the primary financial statements, that is the main format of the income statement, and the role of the notes. As far as the role of primary financial statements is concerned, it is intended to provide useful, structured summaries. In fact, there's a very key set of words. It's a very key set of words. And I think as a community, we need to drive these three words very strong into the DNA of all the preparers. Ultimately, what it seeks to do is achieve in the income statement useful, checkbox, structured, summary. All the three need to fit in. Then it comes as part of the main financial statements. And the purpose of notes is to provide material information which will help understand the line items which are there in the income statements, and to supplement or give additional information for a better understanding of the financial statements. So I think what is very important is to keep driving down the objective which the primary financial statement is expected to achieve and the notes are supposed to achieve. Primary financial statements at the cost of repetition, three keywords: useful, structured, summary. So those, all the three checkboxes are critical for what should actually fit into the main income statement. What will go into notes is the explanation to the line items which are there in income statement and any other additional information which will help a better understanding. As far as the principles for aggregation are concerned, I think they have been fairly well spelled out in IFRS 18, and they've used a set of keywords which are fairly simple to understand, and it is there in our Indian context. It's already there. The good part is Haggett and team. In India, we have followed this for a long period of time that we never thought that so much of science is there behind what we have been following over a period of time. The first of the requirements which is spelled out in the standard is you classify and aggregate the items based on shared characteristics. If they have shared characteristics, you group them as one. Similarly, those which don't have shared characteristics, those you disaggregate the items. Similarly, for those items which are aggregating and disaggregating to present as line items in financial statements, then you go ahead and provide additional summaries as part of the notes to accounts for a better understanding. And key point, I think Haggett talked about in a presentation, or one of her colleagues spoke about, I think one of the colleagues spoke about, is regarding that labeling. And I think Amrita was also highlighting that. And in India, if we have to make one mindset change in India, it is around the labeling of the items, where we have this large head called other expenses. So the other expenses, some of them could be other operating expense, other finance expense, other whatever. I think that labeling part is where probably we need to apply more thought. And what is important is when we do this aggregation and disaggregation, we should ensure that we are not obscuring material information. So those are the broad principles which have been laid down here. And the standard through the paragraphs B78, B110 have given a list of items which will fit this objective of aggregation and disaggregation. Much similar to Schedule 3. So I don't see much of a significant change or effort as far as India context is concerned. And just to conclude on this, and to highlight what Amrita mentioned, I'm repeating it. It's the labeling where all of us need to be very careful as to how do we describe those items? And what needs to come into the main statement and what needs to go into the notes to the accounts. So that's the only area which I feel India has to put effort in. The rest of it, I think it will be a smooth transition.
Yeah, so Haggett, it will be good to have your inputs because you've got a much wider perspective, not just India, but outside India as well. And on India, sorry, I'll just leave with this. I think my sense is, yes, we've had MPV, the requirements through Schedule 3 and otherwise, but I still feel this principle is so pervasive. This would require invariably everyone to reconsider. May not result in a large number of changes, but I still do feel every company will land up probably having some impact, maybe small. But Haggett, will be helpful to have your perspective from, just from what you've seen otherwise. Yeah.
Thank you, Archana. And just to start off by saying I completely agree with what you just said. I think we changed something, and it might be that after the implementation, we wouldn't see a lot of things moving, but it doesn't mean it was an easy exercise. Everyone will need to go through the process of soul searching to an extent to do that judgment about aggregation and disaggregation. And it might be that in India you have a great starting point because your requirements or your local practice already developed with that context in mind, but we see a lot of different things. There are jurisdictions, for example, that the regulator require that in the notes, if there is an item that is more than X% of the total line item, it just needs to be disclosed separately. I'm familiar with those requirements. So this requirement is quite easy to implement from a prepared point of view. But does it provide useful information? Not always. This is why it is something that we need to do. We need to put those requirements aside and apply that judgment and look at the bigger picture and see whether it provides useful information. And I think in terms of implementation, at least my personal point of view, those countries and those companies that have a leverage because they've started with something that is in the same direction, they would only need to challenge their current practices rather than to embark on a greenfield project of looking at all the chart of account and start remapping everything. If you have worked with IS1, with a good practice, with good communication between users and preparers, you just need to look at what you've got and challenge this using the IFRS 18 requirements that require the judgment about looking at different characteristics. So I think from what I hear from Vijay and the others, you have a very good starting point, but it doesn't mean we don't need to challenge what we've done so far. It might be the labeling, it might be in the notes, and yes, the structure might be impacted as well.
Archana, 10 seconds.
Yeah.
I just want to clarify as far as the stakeholders who are listening. Even in India, we have this 1% criteria which is there, but it doesn't come in the primary financial statement. Yeah. It doesn't come as a line item in the current. So it comes as part of the notes to accounts. So to that extent, it's not a significant departure. So I just want to give that comfort to Hagit.
Okay, thank you, Vijay.
Hagit, this one is again a conceptual, it's not there in the final, there's no change in this regard, but it's just a conceptual question. The concept of OCI has never been addressed. It was not addressed in IS1, neither does any other IFRS address this in terms of what is the criteria. So it seems the requirements around OCI are more based on expectancy rather than conceptual. Why has ISB not used this opportunity to provide guidance around this?
So as you've mentioned as well, and everyone knows, this has been a long project and we really needed to have a focus. And we were focusing on what investors were telling us they need the most, and they needed most information about performance of an entity, better information. And I think OCI was mentioned. Yes, it was mentioned in the exposure drafts. I think it was slight labeling proposals, but even those did not prove to provide the clarity needed. So we didn't continue with this in the project. And I think dealing with OCI, what goes to OCI is a matter of concept, and when things are recycled. It's not that we didn't touch it in the past in the conceptual framework, but yes, it's an issue that comes from time to time. I think it didn't park well within this project. If we were to open it, it would extend the project probably beyond presentation and disclosure, but for sure beyond the presentation and disclosure related to performance, which was the focus. And also when we do our agenda consultation, various topics come up. And when we set the agenda plan for the 5 years we are in the middle of, this wasn't ranked as the top priority. So we're always open to this feedback, and if it will come back again as something, but with a higher priority, we might be able to pick it up. But in the context of this project, it wasn't the right place for it.
I know we have limited time, but I just do want to talk about a sector other than, one of the other main businesses, especially the banks and insurance companies. MPV, how do you think this is going to impact the financial services sector? And very quickly, in the sense that we'll also have groups which may be into multiple businesses, more than, it could be into manufacturing as well as financing. So how does a company deal with the presentation requirements if it has multiple main business activities, either at a standalone or at a group level?
Archana, as far as banks are concerned, the format of income statement will undergo a significant change, and for the good. In fact, even if you look at the investors today, while we have a particular format under the Banking Regulation Act, all of them look at the net interest income, the fee-based income as key metrics. So what IFRS 18 now does is brings that financial statement in a more meaningful way, where you have net interest income as a key metric, and then you have the other fee income. And the beauty is all the bank financial statements across the world will now become very comparable. So I think if there is one sector in India where we'll have a substantial change the way the financial statement will be drawn up, it will be the banking sector. And my view, it's a very welcome change. I'm sure ICA will work with RBI, and the new format will be there in time when the banks move to Ind AS. As far as insurance companies are concerned, this format is in sync with IFRS 17 or Ind AS 117. So the way the insurance performance gets measured in terms of insurance result and the investment performance, which is there, I think the same thing gets captured in this format. So once you are in Ind AS 1 or IFRS 17, I think this format is just a natural corollary. It just follows that, and that will be a welcome change. And I expect the regulator to take steps on the same. And as far as the non-banking finance companies are concerned, I'm sure MCA will notify the same. And we should follow the template similar to the banking companies, which has been proposed in the IFRS 18. We have that illustrative examples where there are templates already given by the IASB. I think one of those templates is what we will find. And IASB has also, as part of the examples, given a template of financial statement where you have manufacturing plus customer financing and others. I think that template is there. I think with due deliberation, we should be able to bring in those as part of our Schedule 3 revisions and address the requirements. So my view, to sum it up in simple words, for banks, it's a significant change, but a very welcome change. Insurance companies will follow IFRS 17 and the corollary will come. The rest of the companies, I don't see a significant difficulty in transitioning. With the revised Schedule 3, I think we should get there.
And just related but MPV, I mean, the standard has a definition, or not definition, it has requirements around how do you look at what is main business activity.
Correct.
So
there's a flow chart also available.
Yeah. So for this discussion, we've taken an easy thing, banking, insurance, but I think experience will tell us as to whether there is any implication of how the activity is defined there and how we kind of look at financial services. So any comments on that?
There are professionals like you to help us, Archana. We'll walk through.
So we're short on time. I'll just leave. I mean, anybody can raise their hand. Any bit last few words, any message, and especially on the transition. If anybody wants to share any inputs on the transition efforts.
So, Archana, if I can just come in on the last issue which MPV was discussing with respect to the banking sector. Rightfully, as you said, that it is under the Banking Regulation Act, the format is prescribed. And unless the law is amended, the banks will not be able to adhere to the new format. What I believe could be an alternate way out, which the ASB can think through and take it up to the regulators is, while the banking regulation format remains as it is till the time the law is amended, the statement of profit and loss as prescribed under or in accordance with Ind AS 118, which would be IFRS 18, could always be given as an additional information and an additional document in the financial statements. So giving additional formats is not prohibited under the law. So while you can't amend the law, or you can't follow this till the time the law is amended, but this could always be given as an additional document. I mean, this could be one of the way forward till the time the law is amended. And that too, as and when we really migrate to when the banks start adopting the Ind AS.
I have one more minute before I have to hand over, Sir Haggett. I'm going to just take the benefit of that. From an implementation or transition challenge, anything that you would like to share in terms of the inputs, what you would have got from stakeholders, and any advice that you would have for us?
You seem very much prepared, I have to say. But let me just use the last minute to say, yes, transition is going to be a challenge, but it really depends on the starting point of a company, how different you are from the outcome that the requirements will get us, and the complexity of the systems, the complexity of a company. If it is a group with many subsidiaries, of course, it's very different than a single entity. But what we expect companies and industries to do is, first of all, start with education. And in the next month or so, we also plan to provide some webinars to start education widely. And I think this is something you can support as well locally. And education starts with the first people, which are accountants, but then it needs to go on to everyone in the company, and then of course the stakeholders outside the company. It's looking again at the systems and the processes, and again, my personal point of view, since you have a strong start, is re-challenging and challenging what you've got rather than starting from scratch, but really being open about understanding that there are judgment rather than rules and templates and things like that. Really think deeply and allow for this judgment to be applied. So it will take some time to do that. And also think about other, second order effect of when you change sometimes the presentation, if there are remuneration, if there are other things that depends on the presentation. Just think ahead of those things as well as you're doing your planning. But I think it seems like everyone is ready to go. Thank you.
Of course, it required quite a few changes to the systems and processes, but I think the point you made on stakeholder education, I think that's very important, because ultimately they will be the one using this information. So thank you so much. I'm going to hand this back to the chairman. Sir, back to you.
Thank you. Thank you very much, Archana, and thanks to each and every panelist out here. And it was really a very interesting discussion. I'll request our Vice Chairman Abhay Chhajarji to give his concluding remarks.
Thank you. Thank you very much, Pramod Jain, the Chairman of the Accounting Standard Board, and my sincere and most respectful thanks to the members from the ISB, Hagit, Deborah, Ronnie. Thank you so much for an excellent presentation. I must say you made the requirement which is there in IFRS 18, which is simple, of course, as mentioned by MPV sir. I think the presentation made it even simpler. So I think that is the way you've presented. And thank you so much for your time, sparing valuable time for all the participants who are here today. Special thanks to our Honorable Past President and also the Chairman of the Accounting Standard Board and CA Manoj Fadnaji and CA Vijay Kumar sir, being a past Central Council member, but also the Chairman of the Accounting Standard Board, and always contributing, both of you, Manoj Fadnaji and NPV sir, for any group meetings, whether it's a small meeting, a small issue to be discussed. I think you've been always available for the Accounting Standard Board and for the group meetings. And Madam Amrita, thank you so much for your time, sharing your inputs from the industry perspective, and moderator Archana for excellent moderation. And I must say, I think the time has come. I think this is the way, when you have these outreach programs for the members, for the stakeholders, to make them understand well in advance. I would say this is the best time to start, like having April 24 announced, and within a month's time, we are having an outreach program, whereas the effective date is still 1st of January 27. So you can imagine, how we want to prepare the stakeholders to understand the importance of IFRS 18, replacing the IS 1, and, to have a better presentation, better disclosures for the users. I believe having those breakup classifications of income into operating, investing, financing. And I must say, excellent discussion by every panelist today here. And thanks to also the office for moderating this very important outreach program. And I can share that more than 1,000 members are viewing this panel discussion all across India. So congratulations to all of you and all the participants for being here today. I'm sure we'll have a lot of more outreach program on this IFRS 18 to have more understanding, clarity, but always available from ICI, from the Accounting Standard Board, me on behalf of the ASB, the chairman, Pramod ji, and myself. Any issue, any communication, you can reach out to us. Thank you, all of you, for joining. Thank you for
spending. And Abhijit, in fact, we feel that 2027 is too far, but actually it is not. Because when we'll have to work in ASB, we have to have so much of outreach, we'll have to have exposure discussions, then of course, and then going to NAFRA, then to MCA, which take more than a year, and then educating members at large, preparers at large, and auditors at large. So time is very short.
Having the converged Indias, of course, the process takes long. Yeah, correct. Thank you so much.
Thank you, everyone. Thank you.
Thank you. Have a good evening.
Thank you so much.
Thank you so much. Bye.
Thank you.
It's a pleasure to be part of this. Thank you so much.
Thank you, sir.
Bye.
Thank you so much. Thank you, everyone. Thank you. Yeah, please do.